Welcome to Fintech Frontiers. I'm your host, Stephen Walsh. Today, I'm delighted to be joined by Luis Andino, founder of Ditch.io, a company helping the next generation of workers to pay down their debt. Luis, thanks so much for joining us on the podcast.
Of course, Stephen. It's a pleasure to be here.
Great. And to start, can you tell us a bit about the problem that you're trying to solve and how you're going about that?
Of course. Well, 2 years ago, we realized that wealth was not being transferred at the same rate than it was before, right?
Transferred to...
Sorry,
The
what was that?
wealth wasn't being transferred to the younger generation?
Yeah, correct. So Stephen, 2 years ago, we realized that wealth was not being transferred to the new generation at the same rates than it was before. So in the past decade, we are seeing the older generations hold on more and more to the cash that they have, to the assets that they have. And this is leading the next generation to be much more debt dependent than ever before. On top of that, we're also seeing with the rise of social media, people have this view of what they want their lives to be. And to bridge that gap between what they can afford and what they desire, they're taking on more personal debt than ever before.
Wow.
And so based on that foundation, recognizing that this new generation is slowly but surely making up the majority of the workforce, which is Gen Zs and millennials, we realized that the next generation was entering the workforce with a completely new set of financial challenges. So whereas 40 years ago, a person entering the workforce wanted to invest, to build up their retirement account, to build up their brokerage account, to save for retirement, this new generation has a completely new set of problems. They want to get rid of their high interest debts. They want to clear their student loans, their auto loans, their credit card debt. And in order to do that, we felt like this created this white space for a company like Ditch to exist that allowed employers to partake in their employees' journey to debt freedom by both offering our mobile app, which takes roundups of all the users' purchases and sends those automatically towards their debt, as well as offering other peripheral financial wellness services like financial education, AI financial coaching, budgeting, debt planning. But on top of that, we allowed employers to optionally match their employees' debt contributions and then offer that as a benefit. So if I'm paying off a student loan and I'm making $150 in payments, then my employer can optionally match that, similar to what a 401k match would be, but for debt. And so we've really seen an interesting use case here in bringing this to market, because we create this win-win-win circumstance where for the employee, we are allowing them to effectively get access to capital they wouldn't otherwise have through the employer debt match. We also facilitate these effortless mid-cycle extra payments through the roundups. And then for the employer, they now get to offer their workforce a benefit that fits their financial wellness needs. It helps with recruiting, it helps with retention, it helps with employee productivity, and it's just an amazing thing to do to start building a great relationship based on trust and kindness with the employee.
Fantastic. I can see the attraction of that. So you have both a B2C and a B2B2C route to market?
Correct. Yeah. So our go-to-market strategy includes a lot of direct-to-consumer organic. We've been able to build a great brand and rallying around this very simple value proposition of pay off your debt faster by taking roundups of your purchases and then sending those directly towards your debt, which is a very attractive value proposition for the consumer because it's not dependent on engagement, meaning that I don't have to go and open the app. It doesn't feel like an additional chore. It's something that I can just turn on and I can set it and forget it and start getting value. We've been able to build around that a very strong go-to-market strategy from a direct-to-consumer standpoint. But then we're also finding this very interesting use case by going to market through our partners like employers, where they now get to bring this newfound value proposition to their users. And we found that to be a really interesting mixture of both. While we spend the majority of our time focusing on B2B, our direct-to-consumer strategy, mainly led by organic efforts, will very often yield very interesting results, as I'm sure we're going to talk about in the call as well today.
Oh yeah, no, we will for sure. But before we get to that, I wanted just to circle back on something you mentioned, roundups. Could you just Could you tell me a little bit more about that? Because I think that's part of the way that you help your users to fund repayments, is it?
Yeah, of course.
What
The
how
way
does it
that it
work?
Yeah, for sure. So the way that it works is that every time that you'll download the Ditch app, you'll link your debt accounts, you'll link the accounts that you used to normally spend with, and we're using APIs here like Plaid. And then you will go with your own credit card to a coffee shop and you'll use your credit card, let's say your Amex card at Starbucks. You'll buy a coffee for $4.50. And then we detect that transaction. We create a roundup for it, let's say 50 cents. Optionally, you can add a multiplier to that, which turns, for instance, if I have a 3x multiplier on my roundups, it'll go from 50 cents to $1.50. If I have a 10x multiplier, it'll go from 50 cents to $5. And then that gets slated to be sent as a payment directly towards the debt. So every time that I go and make a purchase, Ditch is rounding up those transactions and then sending the roundups directly towards my student loan, my mortgage, my credit card, my auto loan, with the idea of
Yeah.
increasing the extra payment that I'm able to make in an effortless way throughout the month. And by increasing the extra payment, I reduce the amount of time that it'll take me to pay off that debt, and therefore the amount of interest that that debt is going to pay off throughout its course.
My Starbucks coffee is going to cost me $5 instead of 4.50.
Correct. And the 50 cents is going to go automatically towards paying off your debt, and it's going to save you a ton of money on interest and a ton of time on paying off that debt.
Fantastic. And to do this, though, have you engaged in some kind of open banking integration?
Yeah, so we use two APIs today. One of them is called Plaid, which is very well
Yep.
known. And then another honorable mention is we use an API called Method, which has been wonderful. They do direct liability payment and direct liability integration. So we pull all liability data through that API, which, they're a wonderful company. They're, I believe, a Series B company, so still up and coming, but making amazing
Super.
strides, and they've been a great partner to us.
Good shout out there for them.
Yeah, for sure. They deserve it. They're a great company.
Yeah, super. Great. Well, thanks for explaining that. So you're chipping away the whole time. And is it that, say, if you make a payment, you've got your roundup set, that is it sending that 50 cent over? Is there a stream of small payments that are taking place,
So
in
we
kind of
allow
real
the
time?
Yeah, so we allow the user to configure that. We provide them a range between $10 minimum in actual payment sends up to
Yes.
$25.
Okay, so it can build up and then it'll say there's send $10 over, but it's kind of
Correct.
a reserve
Yeah.
then. Yeah,
It'd be a little bit difficult to send 50 cents at a time just because the payment fees for
might
both of
be
those
expensive.
payments would probably be more expensive than the 50 cents
Yeah, yeah,
in and
for
of
sure.
itself.
Yeah. Okay. 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 Well, that makes a whole lot of sense. And you mentioned also that the younger generations are entering the workforce with all sorts of debt. Could you put some numbers on that so we can get a handle on you know
Yeah.
how much the young Americans are arriving first day at work? How much debt are they likely to have?
Yeah, for sure. So to give you some metrics, the average Ditch user today has $36,000 in student loans on average, $18,000 auto loan, and about $6,000 spread across credit cards. And this is all obviously non-housing debt. And then we also have an average of $4,000 in personal loans for our existing customers as well. So the debt burden
Significant.
is very significant. And then the average interest rates, especially now, considering that interest rates have risen quite a bit dramatically, starting at the federal rate, and that has cascaded down to the individual lenders. We're seeing interest rates, for instance, just to give you perspective, federal student loan has a 6.53% interest rate today.
Chunky enough.
Mortgages are being originated in the either like 8 to 12% interest rate range. Credit cards obviously carry a very, very high interest rate, some like in the range of 20 to 28% interest rates
Yeah.
in some cases. So the interest burden is pretty significant
Yeah.
for these young workers. And the way that we sort of advertise this is that the new path to wealth
Mhm.
building
Yeah.
for these folks that have high interest debt must require the user spending the first few years of their wealth building timeline focusing on clearing the high interest debt, mainly based on the thesis that in a lot of cases the interest rate that debt is accruing will likely not outpace the returns that you're going to get in the
Yep.
market for, a money market fund or a
Yep.
brokerage account, or, God forbid, someone that wants to do their own trading and ends up losing a good chunk of their
Yeah.
cash. So generally it's best to focus on clearing out high interest debt
Okay.
before
So
focusing on wealth building and retirement.
okay. So you've got a mechanism for giving the users visibility on their debt. You've got a mechanism through the roll-ups for helping putting more towards it than just the monthly payments. And then you're helping them orient towards good strategies and definitely getting rid of that credit card debt.
Correct.
Yeah, maybe if you can get it down to zero, it'd be a good time to cut up the card. Or is that
Correct.
too far?
Yeah. That's one of the products that we've been working on behind the scenes, is figuring out how, once that credit card is paid, we can incentivize the behavior of having the user stay out of debt. It's one of the
Yeah,
next challenges that we're taking on, is figuring out mechanisms to promote that healthy behavior
yeah.
post debt payoff.
Yeah. And tell me this, the big question on everyone's lips: buy now, pay later. Is that healthy behavior?
So I'll give you one interesting metric. So in California, every year there's an event called Coachella. It's this like
Yeah.
concert that aggregates, all the young and up and coming,
Yeah.
and
It's
old.
Klarna's favorite time of year, I heard.
Correct. So the interesting metric is that 62% of all Coachella tickets were purchased with a BNPL product,
Okay.
which is pretty starking. And look, it's a little bit too soon to tell whether
Okay.
long term BNPLs are going to be a better, more sustainable credit product. Right now, they do have the cards stacked against us, and there's a lot that we don't know because there's limited reporting. A
Yeah.
lot of these products are configured so that they don't have to be reported to the bureaus. So when we're
Yes.
looking at like TransUnion reports or Equifax data, it's still unclear as to what the
Yeah.
actual impact is. The
Yeah.
one thing I will say is the accessibility of that credit is something that is concerning. And this is something that we talk about frequently. But when you look at 20 years ago, the path to obtaining credit for a 24-year-old looks very different than it does now. So
Yeah.
if 20 years ago you wanted to open a credit card as a 24-year-old, you would have to walk into a bank wearing a suit, letting whatever amount of beard you have grow out so that you look older. You had to bring in a letter from your employer. The process was a lot more complicated. And
Yes.
9 times out of 10, you'd be laughed out of the bank by the underwriter that was recognized that, you're a kid. You should not be taking on credit card debt. We cannot lend money to you.
Yeah. How
Now
things
that path
changed.
looks like you're scrolling on Instagram, you see a product that you really like, you go to the checkout, and you're buying that $1,200, Louis Vuitton bag. And now at checkout, it's
Hmm.
telling you that instead of paying this in full, which you can't do, you can take on a buy now pay later product and check out the generally the and for a lot of these BNPL sub products, the way that their economics work is that the merchant is paying them some sort of merchant discount rate,
Yeah.
and their economics happen right at the majority of their economics is happening right at the point of sale. And so they're not as
Yeah. They're
concerned with the
enabling
credit
the sale to
performance.
happen. So the benefits to merchants, they get better sales, they can complete and the consumer can complete the purchase without emptying their bank account or their credit card.
Correct. And what
Yeah.
we see in a lot of cases is that the user's perception of their cash flow is totally skewed
Yeah.
because they believe that they are sitting on $3,000 worth of liquid assets on their checking account, but really they have like $6,000 or $7,000 worth of liabilities
Yeah.
in BNPL products, etc. And
Yeah.
their actual cash flow is very, very different. We are just starting to understand the impacts of BNPLs in the past
Okay.
few years.
Yeah.
It's hard to tell where this is going to go, but it's not looking good.
Okay. So your actual hangover after Coachella might wear off by Wednesday, but your financial hangover could last at least 90 days, if not longer.
At least 90 days, if not very much longer.
Okay, cool stuff. All right. Now tell me, this sounds really cool and very relevant to young people getting out there. Are you getting much interest in the market for your product?
Well, Stephen, funny you ask. So earlier this week, again, like I said, our two primary go-to-market strategies is, first, we acquire customers organically
Yep.
through social media, and we acquire customers through our employer partners and other affiliate partners that already own our customers. And earlier this week, we had a we had a video go massively viral.
Really?
And
Fantastic.
Yes, and the video got 1.8 million impressions,
Uh,
and we welcomed thousands of customers that were eager to start paying off their debt. And for the past 5 days, there's been very little sleeping and a lot of time in front of the computer, handling
Brilliant.
customer support, making sure that the system maintains, which it has done wonderfully. And that's a huge shout out to our engineering team. We have seen,
Magnificent.
yeah, it's a very exciting time. We've like doubled the business. We've welcomed thousands of users. Again, we've had both of those videos go massively viral, and it's been
Right.
a really really exciting time for Ditch. Frankly, this week is one of those weeks that gives you the energy and the spirit to go and do this again for another year of just
Great.
uncertainty and tragedy, which is what often rules the life of entrepreneurs.
Oh, jeez. Yeah. Well, getting that sort of viral traction must really be a boost, and must kind of validate as well. Obviously, you can see the numbers, you can see the dynamic. You've got a solution out there now. People are paying attention. Coincidence that it's so soon after Coachella? I don't know, but
Perhaps, perhaps.
well done. That's fantastic. Your onboarding process must have been kind of pinned to its collar this week.
Yeah,
Is
so
that
that's
yeah?
that's one of the things that we've spent a long time. So the challenge with a product like Ditch is that the burden to entry is actually quite high because the user not only has to create an account, but they have to link all their liabilities, they have to log into their bank accounts. So the level of security and the level of trust that you have to build with the user in the very first 30 seconds of their experience is actually quite high. And because of where we are as a
Yeah.
company, we cannot advertise with celebrities. We cannot advertise at, football stadiums, which is generally how you build a brand. So we have to do that in the first 10 seconds of the user opening the app. And so the team has really spent, and shout out to our incredible product team, the team has spent a great deal of time making sure that that onboarding experience promotes that level of trust and that it smoothly guides the user to do something that is very, very difficult.
Yeah.
And for this past week, with this influx in organic traffic, and this is a metric, by the way, that I'll say, and it might not mean much to some people, but for the people that understand this, this is going to be pretty shocking. We have converted 31% of all installs into
Really. Wow.
into revenue generating customers, which is, and so to give you a benchmark, that number for most consumer apps is between 1 and 2%.
Yeah.
So
So
we are
you're off the
between 30
charts.
and 15 times higher than the average conversion rates. It's a lot, again, a
And
tribute
what do you
to.
put that down to? That's amazing. It's an amazing figure, conversion figure. So there are people going from the free account to the pro account or the paid account. Yeah.
It's 30% of people that install the app will end up taking a revenue generating conversion action, which again, like,
Yeah.
is wildly unheard of. And I think that's in large part credit to the fact that we are really hand holding our users
Yeah.
through their onboarding. One of the learnings that we've had is that initially we were all about frictionless, quick, easy, very simple. One of
Right.
the learnings that we've had
Yeah.
is that immersing your user into that experience, yes, you will have some churn because there are more steps added
Yeah.
to the onboarding.
Yeah.
But we've learned that guiding the user and immersing them, even if it's at the expense of adding a few screens, immersing them into the experience actually yields to much better net and gross conversions than if you just try to breeze them by linking their accounts. Because
Yeah.
when they get to the
You might
to the
forget that
step,
they've been onboarded.
right, or they're just getting to the stage where they need to link their bank accounts and they're saying, "Wait, what am I doing here? What is this for?
Yes.
I don't really understand. I saw an
Yes.
ad and it looked interesting and I clicked and I'm downloading it now, but I'm not really sure that I understand what I'm doing here." And so
Right.
we've done a great deal of work to immerse our user through the experience. And anyone that's listening, I'd encourage you to download the app and check it out for yourself. We really immerse the user. We give them examples, we simulate what a roundup is, and we put them at like this hypothetical coffee shop and say, "Here's your transaction. This is the roundup. Now press purchase." And then they press the purchase, and then we show them the like a confetti animation saying, "Great, that just rounded up 50 cents. It's going straight to your
Super.
debt." And so we're really guiding them through the
Yeah.
onboarding.
Great. And I think some great insights for other fintech founders there who are trying to design the onboarding process, which is so critical. Any of your paying customers, any of your users are going to have to go through it. But the message I'm hearing from you is, yes, actually, some friction, some degree of friction, rather than having it frictionless. And that's something I've heard from product designers in Keeper Solution as well. That completely frictionless, you actually do need to get some engagement with the
Yeah, and
user so they
maybe
know. Yeah.
And maybe friction is not the right word, but because friction is always bad. You don't want to have the customer face friction per se, but it's a word that I'm using in lieu of saying like less is not always more effective, right? Like
Yeah.
you sometimes you do want to take the time to
Mm.
immerse them. You do want to have it be multi-step and many-step, and often that works. And a great example of this is a company called Noom. You're seeing like around 100 screens before you actually get to their conversion paywall. And so that's kind of how we
Loom.
see it.
Yeah.
Noom,
Noom. Okay.
Noom.
All
They're
right.
a weight loss
Okay.
service, and they're notorious for having a very long, drawn out onboarding that they've tested and it works.
Amazing. Amazing. Super. And may I ask, like, are you, you don't need any kind of money licenses for what you're doing, or?
No, because actually we don't do any of the money movement
Yeah.
ourselves.
Okay.
The money movement is all done by our partner, and then we
Yeah.
actually never even hold the money. So we
Yes.
are we are generating an API call that moves money from point A to point B.
Yeah.
We are not actually moving any of the money, nor are we ever holding the money.
Great. So no kind of formal KYC per se required either for your onboarding.
There is a portion of KYC that's done by Method and Plaid,
Okay.
and
Yes.
we pay those through API. Yes.
All right. Okay. Great. So tell me, what is your vision for Ditch? Where do you see it going?
The vision from day one has always been to maximize impact. The way that we see it, this is a product that should be in the hands of millions of people in America that are struggling with consumer debt. And we want to do everything that we can to make that happen. So, maximization of impact is the number one goal that we have at Ditch. We want the KPI that we gloat over internally is the amount of debt that we've helped our users pay off. And right now, that is the main focus, is to maximize impact. We believe that there are a ton of adjacent value adding services that we can create. To give you one like sneak peek, we're building internally a tool that allows users to make one payment to Ditch, and then we automatically allocate their, actually, we're going to have to probably scratch that. Should probably not talk about that. Anyway,
Yeah,
it
no,
could
that's
be
okay.
clipped in post.
Chris, just take this one out, Chris, when you're editing it, please.
Yeah, Steven. And then also I was gonna say the question about like MTLs, if we could take that out too, just because like so
MTLs.
the money transmitters licenses, like the question
Oh
that you
yeah,
just asked about
yeah,
licensing,
yeah, sure.
I'm not sure how much that's gonna add to the conversation,
Yeah,
and
no
it
problem.
might just spurt some confusion for people.
Yeah. So, Chris, can you take that bit about the money licenses out of it
Yeah.
as well? So that's no problem.
And I'll restart Chris, this is gonna be me restarting my answer towards the vision. So Steve.
I'll give you the vision question again.
Okay, wonderful.
So, Lewis, can you tell me what is your vision for Ditch?
Yeah, so the vision from day one has been to maximize the impact that we can generate on people's lives. There's tens of millions of people that are struggling to pay off consumer debt. And this is a very profitable product for those people. It's a product that generates returns. Those extra payments that you can make through Ditch end up adding up, saving you a ton of time and money on interest. And we want to get this product into the hands of as many people as possible. We take that mission very, very seriously. In fact, one of the KPIs that we track internally the most is the amount of debt that we've helped users pay off. And success for us means getting that number to be in the millions and millions of dollars, which is what we hope to do in the next decade. So
And
really,
does that link to your business model as well, Lewis? That the volume of debt paid off that
yeah.
you're earning, that you're earning a percentage on that, or?
Yes, we do. So we charge a small percentage of every outbound payment on some customers. So
Right.
non-premium customers and non-partner customers in some cases,
Okay. So
we're
if
generating
you're
revenue.
paying for the service, then that's fine. If you're going
Yep.
on the free, okay, excellent.
Yep.
So, and that's a good choice, I think, as well, isn't it? So,
Correct. Yeah, it
Okay.
just gives the user more
Yep.
flexibility to say, I only want to be charged when the
Mhm.
product is working for me, which is when these
Yep.
payments are being made. And even
Great.
then, the payments are still very profitable. So, to answer your question about vision, the vision for the
Yes.
company is just continue to grow and get Ditch in the hands
Yep.
of as many people as possible, fortify our B2B offering, fortify our direct to consumer offering,
Yep.
building the next generation of smarter and better credit products, and get those into the hands of as many people as we possibly can so that we can help tilt the odds back in favor of the indebted.
Fantastic. Well, it sounds like you're making leaps and bounds of progress towards your vision objective in recent times. Tell me, what does the next 12, 24 months look like so for you?
So the objectives right now for Ditch as a company, again, is just maximizing impact. And that comes in the shape of more organic consumer acquisition, growing the presence of the brand, growing our B2B footprint, working with large employers, partnering with companies that want to offer the next generation of financial wellness benefits. And that is what's on our minds.
Yeah.
The only obstacles that we have from point A to point B is time, proper execution, having the team continue to operate at the rate that they are, and continuing to do more of what we're doing and more and better of what we're doing.
Brilliant. Well, look, I mean, it sounds like it's a great thing for employers who are looking to find, to hire, to retain the best talent. Put it into your benefits mix, and it will really help you to do that. So if there are people out there who want to, or companies who want to reach out to you, Lewis, can you tell me what are the best ways to get hold of you?
Yeah, so my email is luis at ditch.io, and then our website is ditch.io. And if you visit our website, you'll very quickly be routed to our employer page, and a contact us that'll allow us to book a meeting right with our sales teams.
Brilliant. Great.
Awesome.
Well, look, it's been great having you on here, and thanks so much, and good luck in the months ahead. It's sounding exciting.
Thank you so much, Steven.
It's a pleasure. Thanks. Bye bye.